Welcome to Buy, Hold, Sell. I'm Ben Clark, and with me today I've got Romano Sala Tenna from Katana and Michael Wayne from Medallion, and we're going to be talking about resource stocks. Almost exactly 2.5 years to the day that the bull market started in resource shares, but we've seen a bit of consolidation lately and some stocks starting to pull back pretty reasonably. Romano, I'll start with you. You've come over from the West. What's your view on where we're at in the cycle?
Yeah, look, I think we've certainly have seen some consolidation lately. We try and look at what the demand-supply profile looks like for each sector, and then try and look at where the analysts are at in terms of they are ahead or behind the curve. I think most analysts, for example, at the moment are behind the curve, so we're likely to see upgrades still come through. So for us, that puts us in a good position for for buying stocks in that sector.
And Michael, expectations count for a lot in this space. Sentiment is very important as well. Where do you think we're at in the cycle?
I think we're probably mid to late cycle at the moment when it comes to commodity prices. We saw a big run up over the last couple of years, but the heat has started to come out. We've seen iron ore and copper start to pull back, and that obviously affects some of the bigger players. There's also question marks over China and whether the same stimulus is going to come through in the next 6 to 12 months that was there, say, 12, 18 months ago. So given where we are at the moment with prices, given where we are with the US dollar, we're pretty sort of sanguine and think we're probably mid to late cycle.
Okay. We're going through earnings season at the moment. There's a lot of information gets released. Rio's been out, disappointed, which was sort of surprising. When you're flicking through the decks of these presentations, is there 2 or 3 things that you're looking for when you're making decisions as to whether buy or sell a stock in the area?
Yeah, look, a lot of people say when it comes to commodity companies, you're meant to sort of buy them on a high PE and you sell them on a low PE. When we look at these businesses, we're looking at the balance sheet, we're looking to see how much debt is on the balance sheet, whether there's enough cash flow coming through to pay off that debt. And in Australia, a lot of the mining companies have really repaired their balance sheets in recent times. There's going to be a lot of cash paid back to shareholders. The question is whether or not the same amounts of cash flow are going to be delivered going forward, and also what are these companies going to do with their cash flow? Are they going to go out and make large-scale acquisitions, or are they going to be a bit more conservative and return that cash back to shareholders?
Yep. Okay. Romano, you had a couple of guys over at Diggers, I hear. Can you give a bit of insight to the viewers? What are you looking for when you hear these companies present? What's something that gets you excited about potentially investing?
Yeah, look, certainly Diggers it's a forum where you can discover really great new ideas. This year, surprisingly, wasn't really any major new companies broken as such. So it was really about the existing performance from past years presenting and confirming what they're doing. There was less hype in terms of the EV space, which we're still very bullish on. And also there's a number of, or a larger number of offshore fund managers down here looking at our gold space. And one of the big thematics emerging is that the Australian gold space has performed much better than our North American counterparts. And so we're starting to see a lot more respect built in there. And the sector as a whole is very flush with cash. The question is, how do they go about now utilising that? And they're very, very focused on making sure they don't just waste that money. Okay.
I mean, you've identified a couple of areas there. We say resources, but there's so many different cycles within the one cycle. You know, the soft commodities are doing it terribly at the moment. The energy guys are partying. Is there one area that you'd zero in on, and maybe a stock that you can give us that you like on the back of it?
Yeah, there's probably 2 areas actually. I think certainly EV. I mean, the EV space has pulled back. The lithium price has pulled back. Cobalt's pulled back. The whole complex there. So you know, it's one of the few areas that we can say we can shut our screen off and come back in 2, 5, 10, 15 years and expect the demand to be substantially higher than it is today, and therefore the price need to be substantially higher. So we're doing a lot of work. We're rebuilding our trading positions in the EV space at the moment. We're also actually looking to add to our core holdings if the prices pull back much more. Probably a second area that we really like and have liked long-term is energy, and in particular LNG. I think everyone's misread how quickly China has been able to build the infrastructure to accept and import LNG cargoes as they become available. And I think, you know, if you're looking for 2 companies here, in the first case, I think something like a MinRes is a standout for what they're doing with lithium hydroxide. In the second instance there, Woodside's a bit of a standout there because they've got the best growth profile for an Aussie energy stock that we're following in the LNG space. Okay,
that's good. Michael, over to you. You know, there's some areas of the resource space that are completely unloved, and there's some areas that are, you know, booming at the moment, which is often what you find. Can you identify one for us that you like?
Well, we don't mind the Australian gold space that was touched upon just then. Basically, we prefer the Australian gold players that produce here domestically, and that way they incur their costs in Australian dollars and they're selling the gold in US dollars. So an environment like we've seen where the Aussie dollar's come back from 80 cents towards sort of 72 cents, that I think is a really big tailwind. So your quality players such as your Northern Star, your Evolution Mining with high grade assets, long mine life and low cost of production are probably the area we'll be looking for at the moment. Because when we're looking at the energy space at the moment, we're not confident that OPEC is going to maintain the production cuts that we've seen over the last couple of years, and that goes to Russia as well. Basically, all the production that's been come out of the market has been replaced by the US shale oil. So for us, that space is a little bit uncertain, and we're far less confident about the outlook for the oil price than we are for the Australian dollar gold price.
Okay. Let's move on to the services companies, because we saw it's typical of the bull market is that 3 to 6 months later, the services companies bottomed out. And in actual fact, in many cases, these have been the better stocks to own over the producers. We're hearing, that they're loosening the purse strings, the producers. Capital raisings are easy to get away for the explorers at the moment. Is there the services stock you like? Do you think this sector has more to go? It's very cyclical.
Look, we think that the sector's probably mid to late cycle along with the broader commodity space. Contracts are going to be harder to come by. But we like to differentiate the sector into two parts. You've got the ones that are involved in the capital expenditure projects, the large developments of mines and building of the infrastructure. And then you have those mining services companies that are involved in more operating expenses and just running these mines at a steady state. So if you think about something like an Austin Engineering or a McMahon Holdings, they provide parts to a lot of these miners and services to a lot of these miners and engineering services, etc. So given where we are in the cycle, given that we're unlikely to see a repeat of the commodity super cycle from 5-10 years ago, I think many of these mines will start to operate at a steady state, and you want to be involved in those mining services businesses that help these mines continue to operate as opposed to expand. Okay,
and Romano, over to you. MinRes, you mentioned before, it's sort of a hybrid between a services company and a producer. Is that a pick that you like on the services side, or is there another one that you'd single out?
Yeah, look, I think firstly, the mining services side is a very difficult and challenging area, as Michael's pointed out there. I think they're prone to irrational behaviour. There's low barriers to entry. They take on a lot of risk in terms of the pricing of jobs, etc., and it's highly cyclical. Yeah. So it's generally an area that we do avoid on the whole. MinRes does have a unique combination of both. Just under half of their EBITDA comes from high margin, long life crushing contracts, and they're embedded at the heart of the client, so it's very unlikely they're going to be kicked off site. So that's certainly one that we do like in the mining services space.
Okay. Well, it's getting pretty late in the cycle, but there's still some good opportunities to be had.